Good morning, everyone. This is John Thomas, the Mad Hedge Fund Trader, with you for our bi-weekly webinar. And we're going to talk about the blind man's market, which it appears we have. But we have to trade the market that we have, not the one we want. So that's the way it is. Go ahead and type your first name in the chat box and where you're from so I can say hello. And let me get the slideshow going here. And there's our blind man. Just a reminder to everyone, Thursday, June 19th is Juneteenth. That is a national holiday. All markets are closed, and that is the first time the markets will ever be closed for Juneteenth. So it will be a surprise for a lot of people. And this is to celebrate the day that the slaves learned of emancipation at the end of the Civil War in 1865. So I see Dan is in North Michigan, um, now in Sarasota. We have Stan from Columbus, Gary from South Carolina, Marcia in Dallas, uh, Christian in Frankfurt. How you doing, uh, Christian? Good to see you again. David in Cincinnati, Garrett in Chicago, Tracy Atlanta, Rudy from Long Island, and Shirley from San Diego. Okay, on with the show here, and I will shortly be taking off for my summer office in Zermatt, Switzerland, changing planes in London, which I do every year, and time to get in some fresh air, clear out the cobwebs, and get some good exercise in. Uh, we are having a spectacular year. Um, we are up 9.94% so far in June. That takes us up to 39.63% on the year, 788 since inception. And we managed to catch probably the sharpest sell off in implied volatilities and options in market history in the last 3 days. And it basically brought all of our positions up to max profit, even the July ones. So we'll talk a little bit more about that later. That gives us a 90.96% trailing 1 year return, 50.85% average annualized return for 17 years versus 25% for the S&P 500. And these are all new all-time high numbers. There's the view from my balcony once I get to my chalet, and it is a killer view. I've climbed it 7 times. However, it's getting more difficult to climb the Matterhorn every year because of global warming is melting the ice that holds the mountain together. They may eventually have to ban climbing on the Matterhorn. Here is the positions that we have left. Um, and I haven't updated the numbers at the top, but we're 20% risk on, 30% risk off. Total gross position is 50%, and I've cut my total positions by half this week to take advantage of the tremendous run up in prices that we've had and the tremendous collapse in implied volatilities. Tesla went from 105 to 62 in 2 days. And if you got in on that, you made a lot of money very quickly. Everything expires our way. We'll be up 43% on the year. We have a bond auction exactly in an hour at 2 Eastern, and that will decide trading for the rest of the day. 22 billion or 24 billion in 30 years for sale. If that goes the way the last one did, then you could get a reasonable market sell-off. So we're hanging on for the outcome of that bond auction, which will take place right at the end of this webinar. Very kind of them to arrange that. U.S. Treasury. The only thing we're close to here is the 540, 550 vertical bear put spread on the triple Qs. Triple Qs have gone up virtually every day for a month. Uh, we're still in the money on this, but we're within $5 of the strike price. And we take a run at that 40 number, then I'm going to stop out and take a small loss. But hanging on now with only 6 days left to expiration. Okay, method to my madness. Let's get on to the first question for today. Will the LA riots have any impact on the market? So far, it has not. The demonstrations have been confined to just a two-block area around the federal building, although on TV it looks like the entire city is engulfed. And they now have the problem, where do you put 4,700 troops? Uh, so far they've been having them sleep on concrete in the federal building parking lot. Uh, but you add more troops in there, where are they going to stay? I doubt they're going to move into the Ritz-Carlton. What's the cost of moving the troops to LA? $134 million. You can add that to the deficit and not get very much for it. Let's see. Another question, what kind of market are you expecting this summer? I expect we'll peak out pretty soon and then go flat um, for the rest of the summer and then attempt another year-end rally up maybe 10% from here, unless we get bad news on the trade front. If we do get another supply shocker on the trade front, we could give up at least half of the recent gains, go down to 5,500 in the S&P 500. So, method to my madness. Um, let's see, let me X out of that. Stocks are now at a very high risk levels due to an increasingly unstable world. Could they go higher? Yes. The momentum is still there, but the risk reward of entering new trades is terrible. Good thing we made our 43% when the uh, implied volatility and the VIX was around 60. U.S. bond auction failure could be the stick that breaks the camel back. 22 billion is due tomorrow. Sorry, that's a correction. It's not today. It's tomorrow. National debt accelerates going to present an increasingly difficult ceiling for stock prices as U.S. Oops, let's go back. As U.S. credit quality declines, interest rates will rise. The top technology stocks will lead all rallies as the return of AI becomes a major market theme and we abandon tariffs and debt default. Uh, safety assets like gold, silver, and T-bills will remain in demand. We've got silver at a new high for the year today. Oil steered dead in the water on recession fears. U.S. dollar at a 2-year low. So let me go to more questions here. Let's see what we've got. Um, What is your favorite agricultural commodity stock to invest in? Well, the John Deere is the best play on the sector. Uh, the and they are moving from a sales to a subscription model. They have a new app that lets farmers predict when best to harvest their crops, and they're selling that on subscription, and it's turning it into a technology stock. Already had great runs this year. Get any more market sell-offs, pick up DE. And inflation seems to be easing up. Do you expect the Fed to cut 25 basis points later this year? And the answer is no, I do not. Uh, as long as you have the unknown of tariffs out there, um, the main concern of the Fed will be possible future inflation, which means no cuts. And the longer these negotiations with China drag out, the more uncertain we are about the level of interest rates, and that's going to cause the Fed to do nothing, which is their favorite thing to do. So you may not get any interest rate cuts for a year. And employment seems to be holding up, but there are some chinks on the armor there as I show you in the numbers. Okay, so global economy is slowing. Non-farm payroll report came in weak. 139,000 was the headline, but if you add in a combined 95,000 in downward revisions from previous months, that brings us to only 44,000. Unemployment rate steady at 4.2, where it's been stuck for most of this year. U.S. trade deficit shrinks at the fastest rate in history as imports from China collapse. Mass government firings are clouding the economic data. Turns out the CPI is being changed. They're only collecting a quarter of the data points that they did up until January. And that is you change your methodology that renders all historic data useless. You're basically and creating new data sets, and that's happening with the CPI, and maybe why it's not going up. Certainly, everybody is asking that question. Are they tampering with the data to make it look more favorable? Um, U.S. economic output will fall as a result of new tariffs on foreign goods, says the nonpartisan Congressional Budget Office. ADP hits a two-year low as new hirings grind to a halt, and hirings of college graduates is gone to almost zero, and that is not reflected in the employment data. Companies aren't laying off people, but they're not hiring either. Everything seems to be frozen until uncertainty goes away. U.S. factory orders dive, ISM manufacturing index down for the fourth month. U.S. economy contracted annual rate of minus 0.2% in Q1. So here is the Mad Hedge Market Timing Index. We are absolutely in sell territory up here, and that's why I say initiating new longs up here, you have to be out of your mind or a very long-term holder, like years long-term. And here's the Market Timing Index today. We're at 66, high end of the range. And notice what this looks like here. This doesn't want to go. Sell. We're approaching that sell 100 indicator. Weekly jobless claims rose to an 8-month high, 8,000 to 247,000. So getting an erosion of the jobs front. And that's what a lot of people were looking for to get a confirmation of a recession that the Q1 GDP data told us was already here. Whenever I get to Switzerland, my first day always is to the town of Zermatt, which is an easy hike. It's only a 1,000-foot climb, has a lot of great restaurants, and it's really reminds you you're back in Switzerland. Okay. Any other questions here? Let me take a look. And let me read these. Um, is the Fed likely to lower interest rates once a new Fed governor is appointed next year? Absolutely. You can count on the next Fed government will be hired specifically for the purpose of taking interest rates to zero. So you can expect a quarter or a half cut on the first day of the new Fed president and many successive cuts after that. Of course, if there is inflation at that time, it'll cause it to take off and really catch on fire, and we could get up to the 5, 6, 7 inflation rates very quickly if they do that. And okay, da- 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 um, okay, just reading through the questions here. What is the best way to invest in oil other than directly in the futures? Um, well, most people are not registered to trade futures. That's why we don't make specific futures recommendations. Um, you can always buy the USO ETF that tracks fairly closely with oil itself, but the real bang for buck in the oil industry is buying oil companies because they have a lot of upside leverage to the price of oil. And my favorites there are going to be Occidental Petroleum and ExxonMobil for the dividend. Okay, House bill that brings 664 billion in corporate tax cuts and therefore stock buybacks is powering the bull market. That is on top of 1.2 trillion in existing buybacks budgeted for 2025. U.S. factories are shutting down on rare earth shortages, no magnets, um, and of course, one of the most heavily reliant companies on imported magnets is Tesla. They're all electric. Sports betting stocks tank after Illinois imposes a 25% betting tax. Meta to buy nuclear power from Constellation Energy to power their AI efforts. Money is fleeing U.S. equities. U.S. equities faced a second successive weekly, and it cut off outflows. Best Buy cut earnings outlooks on the Chinese tariffs. The 60/40 portfolio is dead, with both stocks and bonds going up and down at the same time. And the Nippon Steel takeover got done, 55 a share. Great idea, should have happened years ago. And the Japanese are going to put 14 billion into the new company. Uh, U.S. Steel's technology was really left over from World War II. It was so old. Um, okay, Ultimate Hedge, of course, 4.4% on 90-day T-bills. If you can't hack the volatility or are worried about another collapse in the market, selling all your stocks and putting them into T-bills is a great idea. Okay, here's the S&P 500. We are just short of the all-time high right here. This creates a double top risk. If we go up here and fail, then we're going to go back and retest half of the recent moves. That would take us down to 540 in the S&P 500, and then we launch any new year-end rallies from there. You get a 10% move, maybe make it up to 6,500 or so. On the other hand, we may just chop sideways if there is no bad news, um, and um, uh, and then springboard to new highs in the fall from there. Um, okay, let's move on. Okay, here's the SDS sitting at an absolute multi-year bottom down here. If you're looking for other forms of downside protection, this would be it. Um, the last time people bought the SDS at 16, it made it all the way up to 60, almost a 4 times gain. And we played this one. We shorted volatility uh, by buying the SVXY. We bought it down here at the 32 level, got at 36. It's made it all the way up to 41 as volatility has collapsed. Dow average, very slow grind up. It's a sign of a topping market. Russell 2000, finally getting some upside movement there. And Nasdaq, of course, has been far and away the leader, but we are still short of all-time highs here. This is the FXI, China ETF. There's Japan. There's Europe, all-time high there. German DAX, new all-time high. So foreign markets still outperforming the US by a large market, and even emerging markets have caught on fire on the weak dollar. Okay, so let's look at our barbell portfolio. Here's NVIDIA uh, completing a move from 87 up to 144. That's a heck of a move and is indicative of the entire technology sector, which has been on fire. Um Microsoft, um, uh, new highs for the year. Meta, huge performer. Um, Apple, the developers conference was a complete bust. Nothing new was announced, and that allowed us to take profits on our put spread there. Google also making a nice move up, but not as fast as some of the others. And Amazon also doing quite well. By the way, Amazon is reflecting tariff increases when you buy things in their store, but they're not calling them tariffs to attract attention. They're calling them recent price increases. I just bought a bunch of stuff from Amazon, and everything had a recent price increase of 10%. Tesla, this was just an amazing play. We got implied volatility up to 105% on Friday. I loaded the boat on call spreads there, going all the way out to July. And then we got a collapse all the way from 105 down to 60 in 2 days. It was such a rapid decline in volatility. We were able to take profits on our 180, 190 put spread. That is 140 points in the money. Uh, and we caught a $55 move in the stock. So that was a great trade. If anything, I'm starting to look at short plays now. And again, usually go 100 in the money. So taking a hard look at something like the, 440, 430 put spread on Tesla. It's been a big trader for us this year, both on the long and short side. And we just caught a bunch of longs. Next thing coming into view are shorts. Netflix finally got a sell off. Why do you ask? Well, why have a trade war proof stock during trade war negotiations? So that caused people to take profits, knock the stock down 10%. Still a great company. Want to buy Netflix on the dips. 50% move in 2 months for Netflix. Incredible. It must be because I'm watching more Jack Reacher movies. Palo Alto Networks, the tech letter took profits there. Uh, Another great stock, but also at the top of a multi-year range up here. AMD continuing the rally with the rest of the chip stocks, finally turning around off the April bottom. Salesforce, weak rally here. Don't really know why, uh, but it doesn't seem to be catching fire the way the rest of the tech stocks have been. And Adobe having a nice rally here. Snowflake, new all-time high. Uh, and the ROM, 35 to 69 or 70. Heck of a move. MicroStrategy, the Bitcoin play, you're getting more copycats, companies converting their businesses to pure Bitcoin buying operations. A Japanese company announced they were doing that a couple days ago, buying 5 billion in Bitcoin and over the next 2 years. And that caused this sudden rally here, but we're kind of giving it up again. The more copycats you get, the less the performance on all of these. So, and it does set up a bigger crash sometime in the future. These guys are borrowing money at 10% and putting all the money into non-yielding, zero-yielding Bitcoin. So that will only end in tears, but you can still make a lot of money short-term trading in the meantime. We took profits on our 500, 510 put spread, on our 470, 480 put spread, and we stopped out of a long position here, which was a double position, kept the remaining one. That looks like it'll now expire at max profit. So again, it's the very high implied volatilities that attracted us to this trade. The implied was in the 90s when we put these four trades on, and that is working out very well. Of course, here's the daily goat herd in Zermatt, which they do for the tourists, and always a fun thing to watch. My house is across the bridge and up that mountain. Okay, second half of the barbell. Goldman Sachs rallying hard on the deregulation promise, which may start to happen at the end of the year. All of the financials have done equally well. And of course, our barbell now is tech and financials. That is our play for 2025, basically. You want to buy both those groups with both hands on any kind of decline. Uh, okay, JP Morgan approaching new highs. Same with Bank of America, Citigroup, Charles Schwab, Interactive Brokers, Berkshire Hathaway, again, remaining weak on the Buffett retirement. We'll see where that bottoms out. And by the way, Berkshire's also is getting many copycat stocks. Some of them just buy pure Berkshire stock. Others just buy their portfolio, which is made public. BlackRock, new highs. Now into the miners, metals also, and they have had a great run. And people are buying these not because of industrial demand, but as flight to safety assets, non-dollar plays. So here's Boeing. New high for the year. It's looking like the stock finally turned around. I should probably take down my Il Pesce Marisque Dalla Testa, the fish rots from the head. They have new management now in charge. Uh, General Motors still going nowhere on the trade war and the very high 25% tariffs with Canada and Mexico. Uh, UPS going nowhere, but did get a nice pop the other day on recession worries. Caterpillar, good rally there. Deere, I talked about earlier as your ag play, already had a big move. Look to buy on dips. And Freeport McMoran, the metals play, there is catching on. Walt Disney, huge move on a surprise improvement in earnings. Industrials rallying. Union Pacific still stuck on the bottom. Walmart slowly grinding up. And Costco, 10% sell off here. Don't know why. Probably has to do with guidance. Delta Airlines, you can see some sectors have had huge recovers. Others have barely got off the ground. Delta's one of them, still at only half of their recent loss. Airline travel is starting to slow down, and ticket prices are very cheap, the cheapest I've seen in many years. You can see that also in the transports, also only recovering half of this year's losses. And healthcare, kiss of death on them because the uh, Department of Health and Human Services is making a bombshell announcement practically every day, dismantling America's healthcare system. Amgen, you can see there, not much of a recovery. Visa, new highs as a financial, and consumer discretionary, kind of stuck at this level. And there is a Caterpillar in Switzerland with Swiss license plates. Caterpillar, one of our biggest exporters. You find them all over the world. Okay, so let's go on to questions and see what's come through here. Um, Got that. Okay. Um, okay, keep the questions coming in. Let's get an email question. Okay. All right, so let's move on. Bonds are the big play of the week with the big auctions. Trapped at a low range on the Sell America trade, foreigners are still dumping their treasury bond holdings. We'll see if they boycott tomorrow's auction as they did last month. 16 billion auction bombed last month on foreign boycotts. Uh, Japanese interest rates are soaring, as are long-term interest rates all around the world, not just in the U.S. It's the 30 years part in particular has been getting hammered. The world just doesn't seem to be interested in making 30-year bets with such great uncertainty. Breakout in the 10-year Treasury to 5% is coming. 3 trillion rise in the national debt proposed by the House bill is scaring away long-term bond investors. Bond vigilantes are back. Avoid all interest rate plays. Here is the TLT, and we're kind of stuck at this bottom range for a couple of weeks waiting for this monster auction to get out of the way. Here is the TNX 451, and we actually got to 447 yesterday. Uh, Look for some kind of breakout to this high in the fairly near future, especially if we get a hot inflation. The the thinking is that today's report was the last quiet um, inflation report that we'll see in a long time because it takes 3 months for uh, tariffs to get reflected in the inflation numbers. Junk bonds, new high, back up to new 95. Muni bonds going nowhere. By the way, with muni bonds, if you're about to get a big tax cut, that reduces the value of tax-free municipal bonds, and that's why they're going nowhere. Emerging market debt rising strongly on the currency, and here's the TBT giving up some of its gains. Annaly Capital recovered half its loss, but has been going nowhere for a month. This is Edelweiss, which you only find in the Alps above 10,000 feet. These here. And these lichens, I actually have some of that in my bathroom. I bring home a rock every time I climb the Matterhorn. It has exactly these lichens on them, and I water them about once a month. Uh, okay, let's see if any more questions have come through. Here's a question from John. If they boycott the auction, where are they deploying their US dollars? And the answer is they're buying their own bonds. They're buying euro bonds or bringing the money back into Europe to the euro, which is an appreciating currency now against the US dollar. Remember, from the European point of view, Um, Everything American is depreciated by 20% just on the currency, and that includes our bonds. So dollar hits 2-year lows. You're having a very rare situation where bonds are uh, where the highest interest rate currency is the weakest currency. And that is because of foreign repatriation of all assets, not just bonds. Um, so buy all the currency plays, uh, Aussie dollar, euro, British pound, Canadian dollar, and the um, Japanese yen. Here is the Aussie dollar breaking out to a major new high here. Uh, Japanese yen, euro, British pound, and emerging markets, all rising against the US dollar, which is now the throwaway currency in the global financial system. This is an electric taxi at the train station in Zermatt. I only use these uh, twice on each trip, once to bring all the luggage up to the chalet, which is about a 200-foot climb, and once to bring it all back down again. These little electric taxis, they've been in Zermatt for 30 years. They greatly predate the modern EV effort. Okay, let's see. Do you recommend investing in Australian dollars? I do. I think the weak dollar will continue for years, um, possibly as long as the current administration remains in power. And you could get another 10, 20% in the Australian dollar and the other currencies very easily. Um, okay. Um, Energy is, or oil is sitting on a bottom, but we had a couple of good days this week. So it may be trying to break out of a low range. World's largest group of oil producers, OPEC plus, stuck to its guns at a Saturday meeting with another big increase, 411,000 barrels a day for July. Looking to wrestle back market share and to punish overproducers like other OPEC members. Having spent years curbing production, more than 5 million barrels a day, or 5% of world demand, OPEC countries uh, made a modest output increase in April before tripling it in May. Uh, Shale oil boom is over because of tax subsidized overproduction. Uh, Despite all the promises of easy permitting, um, and opening up of federal lands to oil drilling. Nobody wants to drill new oil wells. The price is too low. And if you are going into recession, the last thing in the world you want to own is oil. Oil companies are scaling back capital investment. Texas, Oklahoma, and Louisiana will take the biggest hits. Okay, here's oil and trying to break out of that low range. We'll see how well that holds. Here's the USO, which you can trade on the New York Stock Exchange. Energy ETF going nowhere. ExxonMobil still on the bottom, but at the upper end of its range. And Occidental Petroleum, a Buffett favorite, also trying to get off the bottom. Nat Gas gave up its great winter rally. The cold weather is gone. And Comico, uranium's been absolutely on fire with the magnificent companies all rushing to line up nuclear power sources. Vistra Energy, another big nuclear operator, also doing great. Of course, also high on the left is to get a crepe at the crepe stand, usually a long line here, and they have multiple flavors. Precious metals, profit taking, And but looks like it's ready to break out, and silver has already done it. 13-year high at 35 an ounce, catching up with gold very quickly. As of Monday, silver had outperformed gold this year for the first time. Known as a safe haven asset and vital industrial metal, silver has surged 24% so far in 2025. Industrial uses account uh, for more than half of global silver demand. And so, if a recession does develop, that could be a drag on future silver prices. $50 till we come. Uh, Gold is waiting for a stock sell-off to go to a new high. It's just been moving sideways for a month during this monster rally that we've had. Um, so here is the GLD, and you can see this technical formation is known as a cup and handle. And usually the way this resolves is it goes up like that. So that's what we're waiting for. Any more dips, we're going to be buying more gold for Mad Hedge Fund Trader. Here's the GDX. Doesn't seem to want to wait to go to new highs. Barrick Gold, another cup and handle there, setting up. Newmont Mining, same deal. And there's your silver trust. That is a heck of a breakout, 10%. No arguing with that one. And my medium long-term target for here is 50, which is the old high, which I believe took place in the late 70s. I'll have to go back and do my research and run my silver my silver piece again, my bunker hunt piece. Uh, and here's the SIL silver miners and Wheaton Precious Metals, which we just so happen to be long. That expires in 6 trading days now, and looking to get a max profit there. Platinum is absolutely ballistic, has become the top performer this year. And there's the world's most expensive McDonald's. I usually go there once just to get reminded of home. Uh, Big Mac meal, $15. With the currency appreciation, the Swiss franc, it's gone up 20% this year. Uh, okay, let's see. Let's take a look at the questions here. And they are selling off the market, but I don't really understand why. I haven't heard any news. It could be a sell the news on the end of the Chinese trade talks, or people getting out of the way ahead of tomorrow's bond auction. The expectations are not great, but we have NASDAQ down 16 on the day. Triple Qs are negative on the day now, and people are moving into precious metals. And by the way, we took profits on our last gold trade first thing this morning. Okay, real estate. Apartment rents are slowing, up only 0.4% in May and 0.5% year on year. This is usually a strong time of the year for apartment rentals. This is having effect on REITs, dragging them down. A lot of them depend on rental incomes for income. Uh, National median monthly rent is now $1,398 a month. Vacancies are at 7%, the highest since 2017. Oversupply, overconstruction is the issue. Housing stocks plunged to one-year lows on spike in long bond and mortgage rates and show no signs of getting off the bottom. Construction spending collapsed in April, down 0.9% for both single and multifamily homes. It's another red flag for the economy. Real estate is a big part of the U.S. economy. More office space is disappearing than being built for the first time in 25 years. A lot of offices are now being converted into residential properties, and pending home sales hit a 3-year low. Okay, Case Shiller, um, New York is the big winner there, followed by Chicago and Cleveland, and prices are rising, but at a slowing rate. Crown Castle International, interest rate play going nowhere. And you can't find a worse chart than this. It's going to be a long wait for lower interest rates to get this sector off the ground again. D.H. Horton was the leading housing stock, dead in the water. So what do we do about this? Well, stocks you want to sell rallies, uh, bonds you want to sell rallies, uh, commodities stand aside, currencies buy dips, precious metals buy dips, energy stand aside, volatility sell over 50, real estate stand aside. And the next strategy webinar, June 25th, from Incline Village, Nevada. Okay, so let me go through here and see if there are any more questions. Okay, we have here. With the U.S. economy slowing, Rudolph is asking, do you see that corporate earnings will increase? No, I do not. Corporate earnings grew at a 14% rate in Q1. I expect the growth rate to fall to zero by Q4, and that is another reason why stocks are very risky here. Um, you don't want to be paying up high prices, all-time high prices for stocks that are seeing their earnings growth go to zero. Not a good combination. Uh, and Babs is asking, is there a chance the Chinese yuan will take over the dollar as a world currency? Absolutely not. Not in a million years. Uh, the Chinese yuan is at the very bottom of the list of currencies uh, that would take over from the dollar. Um, it is a manipulated currency controlled by a dictatorship, heavily dependent on international trade, lacks the depth of the financial system to handle large amounts of international transactions. Uh, and all of their reserves are secret. You know, we don't know how much gold they own, really, and other things like that. So no transparency at all, whereas the United States has all the transparency in the world, or at least it used to. So that is a very safe statement to make. Okay, let me see if we have any more questions here. Um, all right. Okay, I think we pretty much covered them all today. So thank you very much for joining me today. Let's see. One more sunset picture, and that is the sunset at Lake Tahoe with all the boats freshly in the water for the summer. You can see them all moored out here along Incline Village Beach. So this is John Thomas, the Mad Hedge Fund Trader, signing off for today. Good luck and good trading.